we also got Tirthankar Patnaik join in on the show. Tirthankar, hi, morning. You've always been cautious about the macro situation. Morning. What was your reading into the IIP data yesterday and the way the markets, especially banks, behaved?
I think the IIP numbers were better than expectations pretty much on all fronts. Manufacturing was better, at 2.7% versus our expectations of 2.9, about 2.1%. And mining also saw a good revival. We were expecting a down drip of around 5%, but the numbers were down only about 3. And electricity also, which is generally known in advance, but there was some amount of positive surprise. So January's IIP numbers basically passed all the tick marks, and I guess the markets got spooked yesterday at some sense because there was worry that the RBI's cut on 19th March may not really come through. So bond yields also went up from 7.83 odd numbers to about 7.8%. So net what we are seeing is last 2 days have given 2 positive data points. You've had the trade deficit number coming in lower than expectations at about $15 billion, and we expect the March print also to be slightly better from here. And yesterday you had the IIP print, which basically told that the domestic economy might be seeing some kinds of revival. So definitely, green shoots at this point. However, we remain cautious about the macro. We do believe that one swallow does not a summer make. So at this point, we believe that growth concerns continue to dog the economy.
So analyze the impact for us in terms of equities. Do you think after a 4% appreciation or after a 4% appreciation after the budget, low-hanging fruits have been plucked?
I would think so. Markets had gone down, from the 6,100 levels that we had seen before, around the previous rate cut. So I think the market is playing in a range of about 5,700 or so, and the topish end is about 6,100 or so. And if you've seen the massive action that happened on index options over the last 2 days, where nearly $1 billion worth of puts have been bought by FIIs, it just says that a lot of people are not really expecting the markets to go up. From a fundamental perspective, we do believe the markets have a top end at this point around, and one would expect the near-term direction to be weaker actually.
Do you think Tata Motors currently is in a spot of bother? They've lost market share in the domestic passenger car market. They've lost market share in the CV market where they are a dominant player, and JLR last night has reported that China seems to be slowing down.
Yes, there is worry on the domestic side of things, definitely. But what we are more concerned about is, given this, that about 75 to 78% of the valuation for Tata Motors comes in from its JLR segment, we are more worried about what's happening in China. We are still watchful of overall growth pointing out there. Essentially, competitors have done fairly well. Brilliance's numbers were fairly good, in China. So we are actually watchful of what's happening with China numbers for JLR. Be that as it may, overall, we expect the stock to do well, frankly, because there are launches coming in on stream, and overall, the numbers for JLR are expected to be okay. I mean, we will see the wholesale numbers coming in a few days, and that should give us more comfort. But I take your point. On the domestic side, the CV cycle is not likely to improve anytime soon, and that hurts not just Tata Motors, also Ashok Leyland is one stock that we don't like there. And yes, on the car segment, everybody is feeling the pain, frankly.
Morgan Stanley also is making a point that the reason why JLR numbers for Feb were not strong is because of the Chinese New Year, and China was shut for more than 10 days in the month of Feb on account of the Chinese New Year. As a result, the China sales has plummeted, and Morgan Stanley believes that in coming months the Chinese market is likely to recover. Tirthankar, what are your thoughts on DLF? The stock is up 25% this year. It hit a new 52-week high yesterday at a time when the mood or the outlook towards real estate stocks in the real estate sector is negative. What explains the underlying strength in DLF? What is the fundamental story or thesis here?
See, we've been pushing DLF since November when it was around 180 levels. So at this point, I think it's better to take some money off the table given the macro concerns. What actually made us positive on the stock was a string of events which were largely company specific, which were essentially then aided by a macro risk on that we saw coming in around October, November, and which continued all the way until December. Specifically for the company, the debt levels are likely to come down. There was a tangible debt restructuring plan that the management actually put out. So overall debt of around 25,000 crores is expected to come down to, I think, 17,000 crores over the next 2 years. The company was finally able to, find a buyer for Aman Resorts. And thirdly, the wind power business was also sort of, they were able to get a buyer there. And the company has also been guiding that execution would henceforth be much better, and debt restructuring would be something on their radar going forward also, which essentially gave the market and us cause for cheer, and that's why we had upgraded the stock to buy when it was at 180 levels. At this point, given our caution on the macro and given the phenomenal returns that the stock has given, we will not advise entry into the stock, and in fact, some profit booking could happen.
Tirthankar, what's the view on IT now? Considering it's even outperformed the index, are all positives now in the IT pack, or is there still some valuation catch up in any of the names?
See, I think stock like TCS at a 52-week high, one would not be pushing now, but we still like Satyam. Our target price is 140. I think growth drivers are still in place. There is meaningful upside even there. Overall, from a top-down perspective, IT sector has done fairly well. We upgraded the sector from underweight to neutral in our model portfolio earlier this year, and I think with about 25-28% overall returns, one would not expect outperformance from the IT sector going forward, particularly before the fourth quarter numbers and the guidance comes in. But we would not be selling IT at this point from a sector perspective, given the caution on macro. Our focus now is increasingly moving towards a more global portfolio, a more dollar-rated portfolio from domestics, and IT forms a key segment in that particular stance.
Tirthankar, what's the view now on banks, and how are you approaching the sector, both private as well as PSU lot, in light of what your expectation from the RBI is on the 19th? A big question mark there. And how do you think equities would pan out?
See, I think again, let's go back to November, December. What happened essentially was that the market was fairly expecting the central bank to cut rates. That really did pan out. PSU banks did fairly well, but after that we've seen GDP numbers come in much more sober. We did not see big bang reforms at all come in from the budget. On the other side, where the budget did not disappoint was, you did not have any fiscal arithmetic going wrong. So you have a pretty much stable outlook from the fiscal side right now, and which translates to the net borrowing numbers. And on GDP, unfortunately, asset quality issues are likely to remain an overhang for the banking sector. The question there is how much of it is in the price. What we do know for sure is that the central bank is going to cut rates this year. Excuse me. Therefore, the overall cost of funds in the economy are going to come down, and which is why we do have a positive stance on financials. But what we have been doing is, overall we've been cutting off, and we will not be pushing PSU banks as a space right now. And the shift is, if you want to do an intra-sector shift, it's obviously from PSU to private. But let's not forget that going forward in FY14, because street numbers on growth are likely to be panned down, one would see urban consumption actually taking a hit, and that's why we'll be cautious even on private banks going forward over the next 6 to 9 months period.
In the short term though, give us your top 2 ideas from the banking pack.
I think ICICI Bank is one stock that we like in this space, and the other one is of course SBI. The rate cut is going to come in, so we will see SBI moving up.
Titan always has been a very, very expensive stock. Even after the correction, according to the Bloomberg estimates, based on FY14 estimates, it is still trading at a P multiple of 30 plus. At a time when markets in general are not hiding in very expensive stocks, names like HUL, ITC, Jubilant Foodworks, maybe Titan could underperform in the near term if gold prices they correct further. Titankar, would you agree with my assessment on Titan?
I would think so, yes. I mean, gold demand in India has come down over 20% on a YOY basis, and the government's push to limit gold demand, particularly in the light of what we are seeing on the current account, is only likely to get stronger. So, therefore we do not expect, any kind of positive surprise on Titan's revenues at this point, really. So, yeah, point taken.
Titankar, what happens to the mid-caps? Because we've seen acute pain building into the mid-cap universe. In bits and bounds, we've seen some rallies coming in, one-off days for, the real estate pack or some of the infrastructure names. But besides that, does it seem like this could just be the start of mid-cap pain and perhaps there's more downside to go, per se, on the index basis?
I would agree with you, Aisha. Basically, mid-caps have seen prolonged phases where we've seen days where select mid-caps have fallen more than 20-odd%. And we would not rule out such more of these days coming into the future. From a top-down perspective, markets are, in a consolidation phase. People are looking into quality. People are, especially foreign investors, they do not really go beyond the top 150-odd stocks. So this is hardly the time, with the kind of macro overhang we have, to delve into mid-caps. Choices would be very, very specific, if at all, for the overall sector in terms of capital flows also beyond what we are seeing from FIIs, which is restricted and it particularly excludes mid-caps. From the domestic institutions, we believe government equity supply over the next 6 months. I think for FY14 the overall number of about 55,000 crores is going to be front-ended, and that also translates into a fair amount of selling pressure on mid-caps and tier 2 stocks, in our opinion, because unless equity inflows into mutual funds and insurance really picks up over the next 6 months, and we don't see that happening, many of the domestic institutions, in order to participate in the flows, in the supply from the government, would have to get out of their positions on mid-caps, frankly. And lastly, you might continue seeing promoter pain, pledging pain, brokers actually selling off pledge shares, and which could lead to isolated incidents where selected mid-caps could see an enormous amount of pain. So overall, not the time to be in mid-caps at this point, really.
Titankar, domestic institutional investors have been rampant sellers in the month of March. If I simply add what domestic institutional investors have done in last 3 days, they've been net sellers of to the tune of about 2,000 crore. That's little less than $500 million. What is your understanding? Do you think the selling will continue till 31st of March?
See, I guess the initial part of the year saw domestic institutional sell-in. A large part of the DII figure was LIC and a couple of large insurers who saw meaningful redemptions. January, February, March is generally a good period for the insurance sector. Overall, over half the money from first year premium essentially comes in the fourth quarter. This quarter has not been that well, frankly, and we have seen redemptions come in. They had petered out over the last 2 weeks, but we've seen a resumption of that happening over the next 2 days. We believe that until 19th March, that's one macro date, this is likely going to continue, and overall around 31st also, in terms of domestic mutual funds trying to beat up their numbers, you might see some amount of redemption continue happening.